Dear clients and fans of Grant Natosian Chartered Professional Accountants, thank you again for joining me on another session of Tax Tips. Today I'd like to discuss about the Registered Retirement Savings Plan, as all of you know, RSPs. RSPs are a very good opportunity for people to save money away for their retirements. But early on in your lives, you may be hesitant to put money away because it's essentially locked. Anytime somebody pulls money out of an RSP, they might have to pay some taxes on it. And depending on where their income is, when they deposited those funds and made contributions toward their RSPs, right now it could be where their income is higher and they could be taxed at a much higher rate because their marginal tax rate has gone up. Well, that's not always the case. There are opportunities for people to put money away into their RSPs and use it for different reasons. There are two. The first one is as a first-time home buyer. Somebody can qualify as a first-time home buyer more than once, but let's say this is your first property that you're purchasing. Well, the government has allowed each member of a family, a spouse and a husband and wife, to deposit up to $35,000 into their RSPs. As long as it has been in there for at least 89 days, they're able to withdraw those funds and put it towards a down payment on a property. It used to be 25, but more recently they upped it to 35. And quite honestly, I think that they should increase it more with the property values going so high now. 35,000 or 70,000 for a couple means very little. But even so, $35,000 you're able to withdraw on the closing as long as it has been in your RSP account for at least 89 days. So what does this mean? I pull the money out, I don't have to pay it back for a certain period of time. It gives me at least 2 years, the year of purchase and the year after the purchase, that I don't have to start paying it back. But even when I do, I'm able to split this payment up over 15 years. So it's a very good opportunity for somebody that wants to put some money away and at the same time have some tax savings. What kind of tax savings, you ask? Well, if somebody is in the highest tax bracket, they could be getting more than 50% of that back on their tax return. But if they're in the lower tax bracket, I would say that at least at the 30% bracket, it makes sense for you to make the contribution, because you're getting back 30% on $35,000. That's over $10,000 that you would get, that would help towards your closing costs. And that money that is being returned is essentially now being put away for your retirement as a pension. The other option is what's called a lifelong learning plan, and basically this is for usually for people that are going back to school a second time to further their education, or maybe get an MBA or a PhD, and they need some funds. You can borrow up to $20,000, $10,000 max per year from this RSP, and once the schooling is completed, you would have to pay this back over 10 years. So it starts having to be paid back after your education is completed, and it's going to take you over a 10-year span. It's a smaller amount, but it's over a smaller period of time. So it's a very good opportunity if you want to further your education. It does have some restrictions in there, so I do urge you to make sure you read that fine print about how you can use this and for what purposes, what type of financial institutions or educational institutions would be able to you would be able to withdraw these funds for. But great opportunity again there. And again, once you start repaying it back, it goes towards your pension. If somebody is not able to pay a certain amount of that RSP back in a particular year, what ends up happening is that it becomes part of that person's income for that year, only the amount that you had to pay back. So it's a great way for anybody to really have their savings in their RSPs used for something currently without having to pay any tax, withdrawal fees, or any interest on it. However, RSPs do have a long plan, and they are useful for other purposes. Offsetting your income potentially at the highest tax rate could mean that you're getting to your retirement goals faster. If I'm able to take $10,000 or $15,000 or $20,000 a year and I'm paying 45 to 55% tax, I'm getting half of that back, and I'm taking that money and reinvesting it, whether it's in my TFSA or in my RSP again, just so I can grow it faster. So it's a perpetual savings, and you're now able to get to those financial goals, the retirement goals a lot quicker. That's why RSPs are great tools. The investment, obviously, depending on the type of investment you invest, you put your money in, could have a small to high percentage of a return, but at the very minimum, you are getting almost doubling down on your RSP or any other type of investment by getting that refund back from the government. Spousal RSPs are also great to help split the RSP between husband and wife, just in case the government takes away the spousal pension splitting in the future. You do want to make sure that you have that set up for yourself where you can split it over time. But great opportunities for anybody that has that financial goal in mind to do the long-term planning and make sure that their retirement is set, because we all know that the CBP in old age are not enough for us to retire on. If you have any questions regarding RSPs or any other investment products or any tax matters for that you have that you want questions answered on, please drop the message below under this video, and I will try to make sure I answer those questions and give you some more insight. And if you do have any ideas about topics that you'd like for me to discuss, please do so as well. Have a great day.